Hi, I'm Christine Giordano with Markets Group. I'm here with Ash Williams, who's the Vice Chair of JP Morgan Asset Management. Welcome, Ash.
Thank you, Christine. Good to be with you as always.
I was wondering if we could just kind of touch on your career, especially for this current economy.
Well, I've done a lot of things, and at JP Morgan, I work across the asset management business globally and our private bank. And an extraordinary opportunity set. So much has changed in recent years around the world, and uh, with a platform the size of ours, it's very helpful, and it's a completely different world from public pension management.
And you were at the Florida SBA as CIO for how many years?
20 years altogether, two different tours. The first 6 years, 91 to 96. I was then in New York for 12 years and worked on the private side, ran Schroders for the U.S., and was at a hedge fund for 9 years. Then came back to the Florida State Board in the fourth quarter of 2008, made a number of investments during the bottom of the global financial crisis that paid us very well over the ensuing decade plus.
I always thought it fascinating that you came back as CIO right after the great financial crisis.
Well, it was an opportunity to extend something I value and respect, which is public service. And it was also an absolutely generational opportunity to go on a buying spree during a time of global dislocation with the benefit of being at an institution. And I'm going to steal a line from my friend Brett Harris here. If you were large, liquid, and unlevered at the time of global liquidity crisis and price dislocation on financial and real assets, you were in the perfect position. And that's exactly what that opportunity represented to me.
And now we're seeing interest rates cycle back to higher. What are you seeing that's changing within this economy?
Actually, a number of positives. Several things about higher rates. Rates are higher, reflecting changes in the way the world is. We've come out of a deflationary cycle that goes back to the Reagan presidency. Rates were in long-term decline. Inflationary pressures were negative, which is to say they were deflationary. What were the drivers? Primary driver was globalization. You had production of all sorts of things moved to the lowest cost locations in the world, much of that in China, and that drove down costs of just about everything over time. You also had very robust supplies of labor because you were moving production to low-cost economies with very large available labor populations at low cost. Um, that then had a byproduct for investors as interest rates dropped. People had to look elsewhere to get two critical things that all asset owners and allocators need: diversification and cash yield. So interest rates coming back up to more normal levels after being at historically low levels for an aberrationally long period, I think is a great opportunity for investors for two reasons. First of all, they can get diversification in liquid fixed income markets where you can have a very high quality fixed income portfolio that is simple, transparent, publicly traded, highly liquid, and will give you a 6-ish% sort of yield and a total return a little higher than that. That is very different from where we were just a few years ago. So you can simultaneously get a diversification benefit and a yield benefit in conventional fixed income, which means you can re-underwrite your portfolio, simplify it, lower its cost, and raise its liquidity. Two other major benefits here. From a liability standpoint, pension funds are always judged by their funded ratios, and consecutive years of strong financial market performance and now higher rates mean that the net present value of liabilities is in many cases reduced. That's important because for DB pension plans, which have been somewhat controversial in many places, as the funding ratios rise, the sustainability of the fund is less in question, and as investment returns rise and it becomes easier to capture the actuarial return assumption, then again, stability is less in question, and the outside implications to the balance sheet of the plan sponsor become positive, not negative. That's especially true in corporate plans, because with a corporate pension plan, if it's fully funded and the earnings on the plan exceed the actuarially indicated contribution, the corporate sponsor can book the excess directly to profits. IBM, for example, has recently decided to reopen a defined benefit plan that was been closed for many years. So we may be at an inflection point in defined benefit pensions broadly. The other implication of a return of a more inflationary environment compared to a deflationary one is that one needs to think of the asset mix as also offering an inflation hedge. So that then should lead asset owners to consider thoughtfully real assets that simultaneously offer cash yield, long-term value growth, and also an inflation hedge. Think, for example, about infrastructure. If you have infrastructure, whether it's fixed infrastructure or movable infrastructure, fixed might be things like water plants, utilities, transmission lines, literally physical assets that don't move. Movable assets might be things like global transportation infrastructure, ships for moving liquefied natural gas. That's now a huge thing. There's a global shortage of ships. Those strategies are very powerful diversifiers to global equity risk, while at the same time offering very rich cash yields and very powerful longer-term total returns to owners.
Which of course begs the question, does this make a case for active management? I know active versus passive is a decades-long debate.
I would say yes, and I'm going to give a simple example. We just said that fixed income, the income is back in fixed income, and liquid public market fixed income can do things in portfolios today that it couldn't do 5 years ago, simply because rates have come up, yields have come up in both a real sense and a nominal sense. So if you look at what the most common benchmark is for long-term fixed income portfolios, the Bloomberg Aggregate Index, that index excludes a number of the sectors that have the highest risk-adjusted spreads in categories of fixed income. So by being passive, you're making a willful decision to leave money on the table on the same risk-adjusted return. And I would argue from a fiduciary prudence perspective, that's a decision you should re-examine. And at an absolute minimum, you should be doing active management in fixed income. And I would further posit that in equity markets, particularly at a time when you've seen the extraordinary concentration we have today in U.S. equities and the separation and valuation metrics between the Magnificent Seven and everybody else, there are a lot of great values to be found that are at much more reasonable valuations and therefore offer more attractive long-term total return prospects at lower risk.
So, okay, you were known for calling the bottom of the great financial crisis and convincing your board it was finally time to buy. You're known for your ability to almost be prescient about economies. So what should investors be thinking now in this economy?
Every investor should be thinking, I'd rather be lucky than smart. Timing is generally a fool's game, but I will say this. Anybody can make a judgment about whether you're closer to a top than a bottom. And if your allocation has gotten seriously away from your policy norm and all the metrics point to being closer to a bottom than a top, you should go ahead and rebalance. Put the sails out when the wind is starting to come up, and the whole voyage will be faster.
Spoken as a sailor?
Indeed.
You're also known for digging through the tarnished investments that people are avoiding and finding that golden egg just at the right time. What are you thinking now?
Well, you're right about that. The best opportunities by definition offer the biggest valuation cushions. You can only buy an asset once. And if you buy it right with a big price cushion between what you believe its intrinsic value to be and what you're paying for it today, that covers a whole lot of variability over the time you're owning that asset and greatly reduces the risk and enhances the likelihood of a good outcome. So where do you find great assets at the best prices? By definition, you always get the best price on something when nobody else wants it. So by looking at the sectors that are out of favor and combing through them carefully, thoughtfully, with expertise and a very broad and thorough frame of analysis, you can underwrite great purchases. So one area today that's deeply out of favor is real estate. That includes both the hard assets of buildings and property themselves, but also the related credit assets. Today's Wall Street Journal had a story in it about single asset, single borrower bonds having high default rates and what could be problems spreading in that area. That will almost certainly be an opportunity set. People who can pick up assets at pennies on the dollar after doing the analysis and figuring out whether those underlying assets can remain leased up, can remain cash flowing, and continue to cover debt service. Inevitably, yes, there are going to be some defaults that have to be defaults and they're failing assets. But when there's a broad dislike for a sub-asset class, there are always gems that get thrown on the coal heap. And going through that coal heap, looking for the diamonds is worth the effort, and it will pay wonderful long-term risk-adjusted returns. So I would commend real estate to people, and I would also say that the international environment changing the way it is will afford a number of opportunities, because there's a lot of interest in changing where things are sourced. We learned during COVID that if you have supply lines that are overly long and overly concentrated in terms of suppliers, and those supply lines are interrupted, the disruption that causes is extremely hard to overcome, and it takes a long, long time to replace supply chains. So there are investment opportunities around that. The other area I would offer up is energy transition. As we gradually try to decarbonize and electrify, that implies changes in electricity production. It implies changes in how processes use energy, how consumers use energy for transportation. And when we talk about sustainable energy sources, it contemplates changes in how we store energy in between the time it's produced and when it can be used, and how we move it from where it's produced to where it's used. The wind doesn't blow all the time and the sun doesn't shine all the time. So solar and wind are great, but if you're generating solar in the desert of Nevada and you're using it in the northeastern U.S., how do you get it from Nevada to New York? Utilities are regulated on the state level. That's complicated. There has to be change. Storage, battery storage is expensive. A lot of people want to electrify for environmental reasons, but the batteries that are involved under current technologies contain a lot of toxic elements with long half-lives, and thinking of them holistically, their environmental appeal isn't quite as pure as it may seem. So as that technology of cleaner storage, cleaner transmission, all of that has to evolve. There are trillions and trillions of dollars of capital investment that have to take place. All of that will be rewarded. Capital is no longer free. And if you own capital and want to deploy it, you have a world of opportunities at your doorstep that you should thoughtfully look through, find the risk-adjusted mix that gives you the diversification, the yield, the liquidity, and the total return your liabilities demand. That's meeting your fiduciary duty, and that's the challenge and the opportunity before us today.
Okay, I just have to go a little bit backwards. You mentioned real estate. We're in a higher interest rate environment. What real estate might one avoid in this market?
Well, the area that obviously has probably the highest short-term hurdles is urban office, or office generally. I would subdivide that, though, and say even if the office category itself is under some strain, all office is not the same. More recently constructed buildings, say those built post-2015, that are well amenitized, well located in gateway cities, and well tenanted, tenants that are large tenants with investment-grade balance sheets, those are the best assets to have. Most of those office assets have 95% plus occupancy levels right now, and they have pricing power on new space. Likewise, new buildings that are coming online that will be the best product in a given market, if they're well located and in a great market, those are terrific assets. If you have the other side of that problem, which is B and C grade assets in tertiary and secondary markets, or even further down the continuum of centrality of cities, for office use, those are much more challenging. And some of those may literally be valued below the value of the land they're sitting on, meaning the structure itself is worthless. And there the question is always, number one, what's the alternative use for the property? And number two, what do I have to pay to get the property? Because with any asset, if you buy it cheaply enough, it will work. The problem with all investments is if you pay too much, it's not going to work, because you have to have an exit to offset the entry and create the ultimate gain.
Buy low, sell high?
It's a simple thing, but it's exactly the opposite of the way human beings are wired. We tend to chase returns, and because the emotional processing of information and experience is such that losses are more painful than wins are stimulating, once people are burned, they really tend to head for the exits, and they panic. That's why you have periods of illiquidity when there's no bid. When people are scared, they just want to put their hands over their eyes and pray and swear they'll never do it again and ask for forgiveness and be somehow bailed out of the hole they've put themselves in.
Just to change tune a little bit here, Ash, you have been known to survive political environments. You started your career as a legislative aide. You kind of breathed the air of politics early on and forged your career around it. As pension funds are facing increasing political pressures, what's your advice on surviving such climates?
Well, it's like all human endeavor. To get along with other people, you have to understand their perspective. What are their fears? What are their aspirations? What are their needs? And with policymakers, elected officials, regulators, employee organizations, etc., they all have a very specific objective of their own, which may or may not align with the fiduciary duty that an investment officer has. So I've always thought that the best way to get through those conflicting alignments is to have rapport with the people you're dealing with, to understand their needs, to share with them the factual basis of your own circumstance, because many times objectives that are counter to the fiduciary objective of a CIO are based on misinformation. And if you can share truth, people are entitled to their own opinions. They're not entitled to their own facts. So if you can get commonality on the facts and you can get buy-in on the logic, then you're down to the optics. And if you can get the right strategies embraced because of agreement on the facts, then you can manage how accomplishing the strategy is done in a way that offers the optics desired by whoever that counterparty and stakeholder may be. So it's what I would call a case of doing well by doing good. You have to find out what people need, find a way to scratch whatever itch they have, to say it simply, and get where you need to be. You take care of them, they'll take care of you. And then you build a currency of relationship and mutual trust, and the next time it's going to be a little easier.
Are you ever going to run for office?
Not a chance.
Well, thank you for today's interview. Appreciate it.
Certainly.